And fears of the U.S. Fed scaling back stimulus have triggered capital outflows from Asian markets. In China, domestic banks are demanding more money to make up for a lower level of foreign investment in its markets. In Shanghai, our reporter Chang Tao finds out why investors are pulling out.
China's domestic banks report they've increased the 6-month interest rates on loans to each other to more than 4.1%. That's the highest level since the beginning of this year. And China's finance ministry says it sold only about 60% of the 15 billion yuan in government bonds it issued last Friday. Analysts say overseas hot money is leaving China.
The slow economic growth makes the stock market sluggish and unlikely to strengthen in the near future. And the policies to control the property market don't appear to be easing. The weak economy brings down the investment return, so the money will go out.
Earlier this year, both the World Bank and IMF lowered this year's expected growth rate for China's GDP by 5 percentage points to as low as 7.4%. Many experts have predicted the central bank could introduce monetary easing policies to stimulate the country's economic growth as early as next month. But one analyst says if the hot money goes away, China will be under more pressure as it boosts its economy.
If foreign money leaves, the renminbi that were to hedge it will come out into the market in the form of price. If we carry out monetary easing policies in the third quarter, big inflation will arrive soon.
China's central bank says the 67 billion yuan it issued in May to hedge incoming foreign currencies is about 80% less than what it issued in April. Some analysts also predict the central bank may decide to lower the interest rates to make more money available. Zhang Tao, ICS4 CCTV, Shanghai.
And worries about a Fed drawdown of its stimulus and the resulting withdrawal of foreign cash is also affecting markets in Thailand. Tony Cheng reports from Bangkok on the summer chill caused by the pullout of this foreign hot money.
Waiting anxiously as the markets open, day traders in Bangkok prepare for another day of sharp falls. In the past 2 weeks, the stock exchange of Thailand, the SET, has dropped by 13%. The boards are covered in red, as more than $1 billion from foreign investors has been pulled out. The reason for the volatility is here, the Federal Reserve in the US, where quantitative easing could be coming to an end. The stimulus scheme, where money is printed to pay for government bonds, might no longer be necessary, according to the chairman of the Fed. That has caused sudden falls in emerging markets. Investor Wachara Kesawang shows me how much the Thai market grew since the global slowdown in 2008. Foreign buyers found opportunities here that were no longer available at home. But that now seems to be at an end.
Many countries' stock market is coming up because of some part of money from QE project is spread to around the world. But the party will be over after USA call back the money.
The instability is certainly not at an end, though. The SET tumbled 42 points on Tuesday in the afternoon alone.
The Thai Stock Exchange is on a daily roller coaster ride. This morning, the markets are slightly up. The same was true yesterday, but when the European markets opened, all of the gains made were lost in a couple of hours.
The outward flow of hot money back to the US is being felt all across the region. The next few weeks will be a rough ride for those still invested in Thailand. The sudden departure of foreign hot money has left Thai traders feeling an unseasonal chill. Tony Cheng, CCTV, Bangkok.
And joining us now from South Bend, Indiana, with more on what is behind the recent bearish sentiment towards emerging markets is Jeff Bergstrand. He's a professor of finance and an expert on international trade at the University of Notre Dame. He's also a former economist at the Federal Reserve Bank of Boston. Jeff, thanks so much for joining us. Let's get straight into it. So Federal Reserve Chairman Ben Bernanke, thank you, said today that the Fed will begin to scale back its bond buying program later this year if the economy is strong enough. So what could this mean for emerging markets if the scaling back does indeed occur?
Well, first of all, he did emphasize that it depends a lot upon economic conditions. There's the expectation that unemployment will fall to about 6.5% as they forecast over about a year and a half from now. But there is some weakness. But nevertheless, the rise in interest rates has a powerful effect on the world economy, especially in a time when the European economy is in recession, the Eurozone economies, and China, there's a good deal of evidence that China is slowing down. So it will have a negative effect on these emerging markets that are highly dependent on the large economies in the world.
Well, he did indicate that interest rates will probably remain unchanged at 0.25% for the foreseeable future. And this has caused emerging market debt to be very popular over the past few years because investors are trying to satisfy their hunger for some yield. Has that created a bubble in emerging market debt?
To some extent, it probably has. Clearly, what's going on in the United States in terms of the housing market is a clear response in terms of those low interest rates. And clearly, investment abroad is an alternative to the low interest rates here. I agree that the short-term interest rates are not likely to change for at least a year and a half. We are in uncharted territory in terms of the imminent elimination of the QE stimulus, but I'd also suggest that the Fed is going to be very sensitive to trying to disturb markets, so that I think the bond buying, when it does tend to recede, is going to be a very slow mechanism. And it's also reemphasized. He made a lot of emphasis that mortgage-backed securities, a lot of the assets of the Fed in these mortgage-backed securities, they're going to continue to hold because they don't want to be too disruptive to financial markets.
Well, just talk of the reduction of quantitative easing has seen markets around the globe start to dip, particularly in the U.S. And the MSCI Emerging Markets Exchange Traded Fund is down more than 12% so far this year. Is this a temporary setback for emerging markets? And could this be seen as a potential buying opportunity?
I think it is a temporary setback. I think it's led, a large amount of it is actually in Latin America. Brazil is down tremendously, but that's also partly in response to tightening monetary policy that's going on in Brazil and tightening fiscal policy because they've been running a fairly inflationary environment in terms of Brazil. I think the longer term outlook is very good for the emerging economies. I think that China will come back. I don't think the fall in terms of growth rates is that severe relative to their long-term trend of about 8%. I know there is some weakness in the manufacturing sector in China that's very much related to the sluggish growth in the United States and the zero, if not negative growth in terms of Europe. But the Chinese central bank has tended to be very responsive to economic conditions and perhaps can accommodate in terms of monetary stimulus to keep the Chinese economy and to a large extent the world economy on track in the longer term.
Right. Well, you mentioned Brazil, and emerging markets from Brazil to Turkey have been plagued with major protests recently. How much of a risk is this right now?
I think it is a great concern. What's going on in Turkey is getting to be a prolonged affair. There doesn't seem to be resolution. This creates a lot of uncertainty in what was a very strong economy. They had inflation under control, very strong growth. It's a very large economy with 100 million people. This creates a good deal of uncertainty in that part of the region. So it is a considerable concern. Situation in Brazil, while still emerging because of some of these cutbacks, it will be the case that this will be with us for a while, because I believe that the efforts to trim the inflation rate, which is clearly at the top of their ceiling for tolerating inflation, is going to be addressed in Brazil because they don't want to get into any kind of hyperinflationary environment.
Jeffrey, unfortunately, we're going to have to leave it there. We're out of time, but thank you so much. Jeffrey Bergstrand, professor of finance and an expert on international trade at the University of Notre Dame. Well, traders in Asia are getting down to business, guided by the latest statement from the U.S. Federal Reserve and Wall Street's reaction to it. Let's go over to Tara Joseph in Hong Kong to see how the day's trading is shaping up. Tara.
Yes, Michelle, investors are bracing themselves for a rough trading session across Asia today. As mentioned, Fed Chairman Bernanke spooked U.S. markets by setting the stage to end its bond buying program, and that is likely to have a major impact here. Japan's Nikkei down almost 1.5% right now. Australian stocks also more than 1% lower as we start trade. In addition, the U.S. dollar is surging versus global currencies on signs of a strong U.S. economy. Now, China's shares are also expected to fall further when markets open in about 45 minutes. The latest data on activity in China's manufacturing sector is due out shortly, and that could add pressure. Analysts expect a drop in the so-called flash PMI, a survey compiled by HSBC, which serves as a leading indicator of growth or contraction in Chinese manufacturing. However, on the bright side, even though we've been witnessing a sharp pullback from emerging markets by investors making adjustments for a possible shock from China, the outlook in Asia remains, well, relatively upbeat. The Asia Corporate Sentiment Survey climbed for a third straight quarter, posting a 71 reading in June. That's higher than it's been for a year. Any reading above 50 reflects optimism. Another interesting survey may change your view on the pace of life in hectic Hong Kong. A new poll by office space provider Regis says work-life balance in Hong Kong is now on par with Canada and better than the US and Australia. This year's survey marks a big change for the territory's rating for productivity at work and its family-friendly policies. So you see, Michelle, that's why I'm smiling, even though it could be a very tough day in the markets. Back to you.
Absolutely. You've got the better end of the work-life balance stick there in Hong Kong. Not such a good deal here in the US, according to that survey. Thank you so much, Tara Joseph, live for us in Hong Kong.